Next, we're going to talk a bit about fundamentals. And today I'll be talking about the conclusion on Friday's non-farm payroll results. So on Friday, last week, we had the non-farm data, that is the US payrolls, and what does it mean overall, okay, to the market. Now, the non-farm payroll report for November delivered mixed signals. One thing's for sure, and I also informed everybody last week on Monday itself. I said that, look, you're probably going to have this because you have a very bullish non-farm payroll number, increasing in the jobs. At the same time, you will also have a very high, not very high, but a upticking unemployment. So that actually played exactly to what the forecast, because job creation rebounded sharply with 227 jobs added. And this is due to the disruptions of October's Boeing strike plus Hurricane Milton, right? So overall, this strong headline figure was accompanied by a rise in unemployment rate to 4.2%. That's a decline in the labor force participation rate and significant drops in full-time and part-time employment. Wage growth of 4% year over year further highlighted underlying strength in certain labor market segments. And you can see from here, this is good, wage growth is good, that's going to support, the US economy. But here, unemployment rise. So what is actually happening here? This is like one way or the other. Now, you need to know one thing. Non-farm payroll numbers and unemployment are two different things. Okay? So this unemployment here includes those have just retired, not actively looking for jobs, but then again, there are many kind of segments inside there, but we need to know overall, because first thing first, here this may be jobs that really is important to the economy, but from here, maybe those are the jobs that, like for example, government jobs, and that's not really going to assist the economy greatly. Okay, those kind of things. So you need to look into detail all these things. So after all these results came out, all these mixed results came out, one thing's for sure is that the rate cuts look like it's still going to go on. So why rate cuts are likely why rates are likely to be cut? So despite all this robust job creation, the Fed is going to cut rates. The reason is because three things. The first, rising unemployment rate. Now, the unemployment rate edged up to 4.2%, and broader measures of unemployment, example, the U-6, also rose to 7.8%. Now, these metrics provide the Fed with a rationale to argue for the need to protect the labor market against further deterioration. Number two, labor market weakness beneath the surface. Labor force participation rate decline, which contributed to the high unemployment rate. Fewer people actively participating in the labor market can indicate discouragement among workers or structural barriers to employment. While healthcare, leisure and hospitality and government-led jobs gains, sectors like retail trades were notably absent. A lack of growth or losses in certain sectors hint at uneven recovery. And finally, the Fed's commitment to easing. It's also one of the reasons why we're probably going to see a cut, because the Fed has maintained that its goal is to support the labor market and prevent further softening. Rising unemployment provides a convenient justification for rate cuts, even in the face of robust payroll growth. So market implied odds for a 25 basis point cut have risen to 86%. Now, last week before the non-farms, we had a 66, and that increased to 70 plus. Now is at 86, reflecting the market's alignment with this narrative. So end of day, what's next? So looking ahead, the Fed's December meeting is expected to result in a 25 basis point cut, bringing the Fed's fund rate down from 4.75% to 4.5%. Okay, So the next FOMC meeting is scheduled for January 29, and current odds suggest a pause in January following the December cut. Means that one cut here, January probably we won't see a cut. And why do we say that? Because pre-report estimates of a January pause were at 57.8%, but after the report, non-farm payrolls report, they climbed to 62.9%, and that's very near to 70. And when you all know when it's near to 70, the probability is even higher. Okay, so this is in line with the Fed strategy to ease rates gradually. So the conclusion is this: the November non-farm payrolls report underscores the labor market that's strong on the surface but reveals cracks underneath. So December rate cut is highly likely, but the labor market's mixed signals might influence the trajectory of future monetary policy. So we may be sure about December, but the rest we don't know yet. Wait for the dot plot that's going to come out together in the December FOMC, so we will know. So whether this easing cycle proves to be a preemptive economic support, what we have seen this year, or misaligned policy responding to selective data, its real effects will depend on how broader labor and inflation trends evolve in the coming months. At the end of the day, rising wages and stable consumer confidence could bolster short-term spending, though uncertainties in employment metrics remain a cautionary tale for sustained growth. Okay, so just be on the lookout, and that we'll see 3 important dates going to come out. Okay, first you have this FOMC. They're going to come out with a dot plot. Okay, that is going to give you that direction. Probably next year 2025, how many cuts going to happen? Number 2, when we have the January 20th. That is when the what do you call Donald Trump is going to be appointed again as the president of the United States. And you know Donald Trump, he has a lot of policies that he has decided he's going to implement when he comes into office. He's already very actively doing this already. So when it comes, these things can change, because at the end of the day, the Fed, he's going to do, argue with the Fed and say this is supposed to be, this is the right thing to do, and so on and so forth. Okay, and whether that's going to work or not, that's the third date, the important date. That is the 29th of January. That is the next FOMC meeting. So once he steps into office, 9 days later, you're going to have this FOMC meeting. So these 3 dates, put them down in a calendar, because that's going to bring a lot of volatility into the currency market as well as the stock market. Okay, the US stock market for that matter. So with that, that's the report for today.